FTX is an unregulated cryptocurrency exchange based out of the Bahamas, and it has collapsed recently. Something which, it's happened before with cryptocurrency exchanges, and as everyone knows, history never repeats itself, so who would expect this to happen again?
Never.
No, never. I kid, but the difference in this one is the FTX was huge. So comparing it to other exchanges that have collapsed for, the first one, the big one, which is always cited, is Mt. Gox, one of the first Bitcoin exchanges, if not the first, depending on how you really qualify an exchange. That fell apart in early 2014, which it at the time, Bitcoin, the entire market cap was 10 billion. So effectively the entire market cap of cryptocurrencies as a whole was 10 billion. FTX was valued at 32 billion just earlier this year. So entire Bitcoin in 2014, 10 billion. FTX, 32 billion.
Mm-hmm.
So the reason why it got so big was they lured in significant investment from SoftBank, Kevin O'Leary, Tiger Global, and even the Ontario Teachers Pension Board. One of the other notable ones is the prominent VC fund, Sequoia Capital, and it was just purely starstruck in their meeting with the CEO of FTX, Sam Bankman-Fried, or SBF. Sequoia partners were practically begging to give him money, while he was, as all serious CEOs do during meetings, he was playing League of Legends, which Sequoia, they were displaying this on their website until very recently, where they wiped it off now. So really, what happened? Did all these people and funds just do no due diligence, or something more happening under the surface at FTX? Let's take a quick look back. SBF's Sam Bankman-Fried founded FTX in 2019, and it quickly became the go-to exchange for many institutional investors looking to gain access to cryptocurrencies. He was constantly in the public eye. He testified in front of the U.S. Senate, a major political donor to primarily Democrats, but also to a lesser amount Republicans. And only a few months ago, he was an altruistic savior of the cryptocurrency space when he bailed out Voyager Digital, supplied liquidity to others following the Terra Luna collapse. He charmed institutional investors and many cryptocurrency users over the last few years, leading to the rapid expansion of his firms. So how did the man, who everyone was seeing in these great eyes, he was a great person, wipe out billions practically overnight? The collapse of FTX is a case of fraud, poor management, and conflicts of interest. The direct downfall of FTX was against its own terms of service. They lent out customer deposits, primarily to its trading arm, which technically a separate company, but in reality it's the same company. It was owned by the same people. The way they were interacting, it was the same company. It was the same organization. Put up an organizational diagram of how they were interconnected. It's just a mess between all their subsidiaries, but we'll focus on FTX Alameda for this. Alameda Research was ran by the 28-year-old and supposed girlfriend of SBF, Caroline Ellison, who had previously stated they only use elementary school math to run their risk management services.
Yeah, absolutely could pull it off without my math degree. Use very little math. Use a lot of elementary school math. Being comfortable with risk is very important. We tend not to have things like stop losses. I think those aren't necessarily a great risk management tool. I'm trying to think of a good example of a trade where I've lost a ton of money. Well, I don't know. I probably don't want to go into specifics too much with that.
Having bad trades is just one thing in a trading firm. It's expected. You're going to have some bad trades. You're going to have losers and winners. But at the time of that interview, she was likely using funds fraudulently gained from FTX to fuel losses that she was accumulating. The public collapse of FTX became apparent in early November. The public got its first glimpse in the chaos of Alameda Research on November the 2nd, a leaked document showing the massive hole in the balance sheet only covered by its sister firm's FTX's FTT token, the same token that FTX can print in the former central bank would like $1. Having the token on its balance sheet it's not a surprise, but roughly $6 billion of the $14.6 billion of assets were in FTT. So about 40% of your assets are something you can print And in reality, that doesn't have value when you can print your own. And worse, Alameda was using FTT to leverage itself. So if FTT can't easily liquidate or sell the token off, it can't pay its liabilities, which of course, that's what happens. On November the 6th, the CEO of Binance, CZ, the largest competing cryptocurrency exchange, held 2.1 billion of FTT and announced its plan to liquidate its assets as it was exiting its FTX equity position, which it previously held equity in. It was one of the early founders of FTX, well, early capital providers of FTX. And as that's announced, people ran for the exit. And it caused the insolvency of Alameda and FTX, causing a bank run of the customers' deposits. Lynn Alden puts this event into a wonderful analogy. Imagine McDonald's makes its own money, let's call them clown bucks, keeps most of it, sells some to the market. McDonald's then uses the remaining clown bucks as collateral for actual loans, and then people remember clown bucks aren't real. And then Starbucks comes and market sells the clown bucks they were holding while reminding the market clown bucks aren't a real thing. McDonald's balance sheets is trash with their clown bucks wiped out. Anyways, that's what happened in crypto land that week, is how she concluded.
I like that, clown bucks.
Yeah, it's a great one.
Wow, so they took customer deposits and they used that money so that they could make high risk trades.
Yeah.
Which they then lost on.
Yep.
Right. And so just imagine that. Like you put your money in a bank, say, right? You're maybe getting a little bit of interest. You're expecting that it's going to be there when you go to make a withdrawal. And they go and take that money and they bet it on the most riskiest things they can bet it on. And if they win, they keep all the money. And if they lose, you lose all your money.
Yeah, I mean, the fact that they had no wall between their trading firm and the exchange is insanity. But I mean, apparently this goes on all the time. I mean, brokerages do it more than, in the equity world more than we'd think.
But brokerages don't use customer deposits as fund to fund their trading business either, though. Like that's we
would hope not. Well, has it never occurred ever?
It would have.
Has it occurred ever? Ever?
Has it occurred ever? Oh, I mean, I'm sure to some extent it has, but
no. I mean, this is. How did this? 30-something or under 30, basically. Like he was a former trader. That's what he was. He's a former trader, and he convinced millions of clients, or over 1 million clients, some of the wealthiest in the world, without a great deal of due diligence, to invest either in or via a Bahamas-based cryptocurrency, which lacked a basic board of governors and really much oversight with any teeth at all. The exchange had a partner firm, Alameda Research, which is his own trading company, which had a significant performance of it, or portion, of its assets in FTX's native token, FTT. Its own crypto, as I understand, which basically, I can't value. It has no value, but people bought it. To me, it just appears that fear and greed drove people insane, and there was no basic due diligence being done into this company at all.
Pardon? They liked his energy.
Well, that's what
had a good story.
That was literally posted on Sequoia's. Right? Sequoia is one of the largest VCs in Silicon Valley.
We liked his energy.
Yeah, well, no, that was part of what gained him. Listen, no, but honestly, it's part of what gained him the capital in the seed valuation was his amazing energy. And Brett pointed out in those moments he was playing League of Legends.
Yes.
As he was pitching this, and Sequoia, the entire investment committee, was wetting their pants over his vision of digital currency in the whole world. Like, he wasn't taking any of this seriously. It's not like this was an original programmer that was programming the blockchain, the technology behind this. This was an individual who was a trader selling them on something, really. He went to MIT. He's probably likely fairly bright, but honestly, and then the others he had involved, like if you look at the trail here, his girlfriend was the CEO of Alameda. And do a couple Google searches on her. She's from MIT as well. probably relatively smart, can do the math, but
what were some of her needed elementary school math?
Yeah, I mean, but some of her biggest quotes were, "You have to being comfortable with risk is very important," and giggling as she said it. And this is who you're trusting with $10 billion to be the CEO of that company.
And then energy, though,
she was. Sorry?
No, go ahead. I'll let you finish there.
Well, she was asked about outlining times when she lost money and saying, after musing over it, she said it was hard to figure out a time when she can recall one, but she could probably not get into the specifics of the time she had lost money, and then just laughed it off. Like, these interviews are out there, and people have invested in this firm and put their clients' capital in these companies. I mean, it shouldn't shock me, to be honest, but it still does shock me that investors put money behind companies like that without significant due diligence. I would say don't always follow the herd. The smart money can also be really, really, really dumb. And if you don't understand something, don't invest in it. Blockchain, for me, appears to be a wonderful technology. The world is continuing to look for many use cases that may change the way we conduct business. But to force its success on millions of crap coins or some NFTs that hold little intrinsic value just doesn't make sense, and really is going to lead to fraud and has led to fraud and just sad losses in people's portfolios. And to be honest, they should take responsibility for those losses, because you're investing in something without understanding it, without having any ability to gain a fundamental value or intrinsic value to what you're putting your money into. Stick to businesses that you can understand in regulated industries with your hard-earned dollars, or this can happen.
Yeah, certainly. It reminds me, just talking about his energy, it reminds me of a quote from Warren Buffett. And I'm sure I'm not going to have the quote perfectly, but he said that when he's investing in a management team, the 3 requirements is that they need to be intelligent, they need to have high energy, and they need to be ethical. And he said that those 3 things together is what makes a great management team, what makes, in turn, a great investment. But he said if you only have the first 2, the intelligence and the energy, but you don't have the third, the ethics, then that's essentially the worst case scenario, because they will actually absolutely kill you.
Yeah, and that may have went on here. Yeah, exactly.